Hey, everybody. Welcome back to our monthly live informational webinar. Welcome, everyone. Thanks again for everybody for joining. We're super excited to have Daniel Foch do a short presentation for us. It's going to be everything economics tonight. If you want to pepper in some real estate in there, I think it's great. And as always, I got my business partner, Corey McKinnon, on the call. Say hi, Corey. Hi, Daniel.
Hi.
Awesome. Okay, so what we're going to do here, we're not going to mess around tonight. I think we're going to just dive right into it. I'm going to just tell you guys a little bit about how the webinar tonight is structured. It's going to be super easy, very, very engaging. Not only is Daniel super engaging, but with the topic, it's a hot topic. So there's going to be lots of questions. So what we decided to do, Corey and I decided it would be great to have Daniel come on. He'll do a short presentation, give us an overview of what's really happening out there in the economy, and then we're going to have a fireside chat. And what that means is we're just going to have a conversation with Daniel based on things that he brought up in the presentation, ask him some questions, and we want to encourage you guys to post some questions too. So while he's doing his presentation, I want you guys to put some questions in the chat. And before we do that, though, let's warm up and see who has jumped on here. So I'm curious, as always. I want to see where did everybody jump on from tonight? Where are you guys coming? We see a whole lot of people here. So let us know where you're streaming us from. Myself, I'm in Milton. Corey, where are you at?
I'm usually in Sarnia, but tonight I'm more out towards London because we got some stuff going on here in London.
Awesome. Oh, Manny's in Halton Hills too. Hey, Manny. Woo-hoo. I'm in Milton, Ontario, which is Halton Hills and, just on the west side of the GTA. Where are you at, Daniel?
Like Queensville, Ontario. So 45 minutes north of Toronto in the country.
Oh, it's a good thing you got internet.
Yeah, internet's great here, actually. We just got Bell Fibe.
That's awesome. Oh, we got Penticton. I think Penticton's going to be the furthest. Who else is from far away? We got Sarnia. So Alex, we got another Sarnia boy. Maybe you know him there, Corey. We got Toronto. Woo. Dwayne Roy's in the house. Okay. I had a conversation with Dwayne. I don't know if you know him, Daniel. I think you do, right?
Yeah.
So we had a conversation, and he's going to have some great questions for you. He's like, I can't wait. So it's going to be awesome. All right. Corey, do you want Cambridge, Beaton, Ontario?
Yeah, where else we Ottawa got in there? Welcome from
Ottawa. Awesome. Good stuff, guys. Caledon. All right. Stony Creek, Kitchener. Awesome. All right, guys. So what we're going to do is I'm going to throw it over to Corey here to introduce Daniel, because Corey is so much better at introducing people than I am. And then we're going to get Daniel to start with his presentation. All right, you guys ready to rock and roll? Yeah. Let's do it. Corey.
We are. Cool. First of all, I just wanted to thank Daniel for making some time tonight, and he's been very generous over the past year and a half on our stages and to our audience here. So for people that don't know Daniel, he is the main host of the Canadian Real Estate Investor podcast. So if you're not watching that podcast, you guys are missing out. Lots of episodes, and they just go all in on helping to inform people about what real estate is doing here in Canada. So make sure you guys tune in for all their episodes. He's also the broker and chief real estate officer at a new real estate brokerage, which is Valerie.ca. So if people don't know what Valerie is, I'm sure Daniel's going to talk about it a bit tonight, but it's Canada's first AI brokerage. And it's got to be one of the first AI brokerages really in North America. But this is where agents can work smarter and delegate some of the tasks that just doesn't make sense for an agent to be doing. And obviously really incorporating tech into the life of a real estate agent. So super excited about that. I remember seeing more about this almost a year ago. I think it was at our event last September where they had the shirts on and everything, and they had some of the people there involved. So without further ado, just wanted to thank Daniel again for making some time tonight. He's a busy guy and a father, and gets lots of requests. So Daniel, welcome to our live stream tonight.
Yeah. Thanks for having me. My pleasure as always. And I'm excited to get into it.
I purposely haven't shaved for a couple weeks because I needed to
Nice.
keep your game up to you.
Yeah, I forgot to shave for maybe a little longer than a couple of weeks, but
all right, the stage is yours.
Okay, yeah. Is my presentation up or? Oh, perfect. There we go. Nice. This is a fancy little platform. So yeah, quickly just going to give you a overview of what I'm going to cover today. I don't plan on spending a ton of time going through this stuff. I think I'd rather do like a little bit more conversation than presentation. But there are some factors that are pretty important, obviously. The key ones being what's happening in the debt market. We've got your big six banks sort of mentioning that rate cuts are potentially over indefinitely. The Bank of Canada's most recent models show that the entire financial sector sort of expects rates to be where they are through to 2027. So I'll talk a little bit about that, why that's kind of happening, and the way consumers are interpreting the market, and maybe who's right. We'll talk a little bit about the housing market. June was like one of the worst months that we've ever seen. It was the worst June we've ever seen, actually. Like even worse than June in the middle of the 1990s housing crash. That's for a number of sales, but not necessarily a bad thing. I think, from an opportunity perspective, like if you're holding assets and expecting a sale, it's obviously challenging, but from an opportunity perspective, acquisition mode's starting to ramp up. Opportunities are starting to appear, I think. And then I talk a little bit about the economy as well. The big one being trade war and sort of like the risk of a pass through in some of these costs becoming inflationary, and whether or not that's sort of part of what the Bank of Canada is pausing for. So anyway, we'll get into it. If anybody has questions, feel free to just interrupt me. I'm pretty good at just monitoring the chat. So if you want to ask a question, I can just read it aloud and try and answer it, provided that it's relevant to what I'm talking about. So let's start with debt. The delinquency rates for most credit products are rising. Mortgages and HELOCs are obviously still very low. I would say delinquency rates for all products are quite low in Canada, but they are rising at a relatively concerning clip. And most of your financial institutions are forward-looking with this stuff. So especially the Bank of Canada, if they start feeling like we're going to see a huge spike in delinquencies, I would imagine, I'm not a policymaker, but I would imagine that there is some degree of like economic Darwinism that they might want to take place. We got drunk on cheap credit for the last 4 years, or maybe the last 20 years, and the hangover from that is going to suck. And we'll talk a little bit about that and how Canadians are deleveraging and how I think that that's part of the process of what is really going to heal our economy. But in the meantime, I mean, delinquencies are rising, but they're really not of major concern. They're still lower than they were in 2019. And I think a big part of that, to be honest, has to do with changes in the recourse environment that took place in 2020, in such that this thing called the Canadian Mortgage Charter came out, and lenders really don't have to push you as hard on, going power of sale, as an example, if your mortgage is delinquent. And you have a lot of options as somebody who is behind in a mortgage. I'm not going to say like go and test that assumption by not paying your mortgage, but for people who haven't, they do provide you a lot of options, because it's much more convenient for them to like help you work it out than it is for them to have to report you as a delinquency after 90 days. And so you have options to try and sell your house. You have options to blend and extend on amortizations if you are experiencing real financial distress. There's a lot of different things that can take place. And so I think that actually could be, if we're trying to look at a reason why delinquencies might be so low, given the economic set of circumstances we have, could be among them. So I'm going to start off by talking about sort of what consumers think are going to happen with rates. And to me, consumers are really clearly communicating that they believe interest rates are going to fall. So, and the way that they're doing this is they're taking variable rate mortgages. So variable rate mortgages are by far the leader of the type of mortgages that are being taken in the last couple of months. And they recently took over. And even before that, consumers felt that the rates were going to fall by taking shorter term fixed rates. So even in this time last year, people were taking 3 to 5 year fixed, so mostly a 3-year fixed product, assuming that they're getting, they were priced relatively well comparatively, and you would take a 3-year fixed and hopefully renew at a cheaper rate in whatever 27, 28. But that's been replaced. You can see that mortgage product falling off of a cliff here and towards the end of 2024 and around the same time. And this was sort of when the Bank of Canada started cutting more aggressively. People started taking variable rate mortgages in an effort to try and capture that downside in rates. So our consumer is stating with their purchasing decisions that they believe that interest rates are going to fall. The bond market doesn't agree with that, at least as of, this is a 1-year look, but our rate environment is actually comparable, a little bit lower than it was this time last year. This is our bond market kind of indicates where your fixed rate is going to end up being priced. Most of your fixed products end up being GOC plus like a 1% to 2% risk premium, because basically the government of Canada, if you're RBC, you can either lend money to the government of Canada and get an interest rate of 3.1%, or you can lend money to me or Corey or Danielle and get an interest rate of 4 to 5%, let's say. The bond yields jumped up pretty substantially yesterday on the CPI print. So inflation was a little bit higher than expected, but and core inflation, well, it was actually lower than expected, but it's trending in the wrong direction. But core inflation was like 3%, and the Bank of Canada really looks at core inflation. So all of this to say that the bond market feels that rates might actually be higher for longer, and that some of the forecasts from RBC and I guess 3 of your big 6 banks are of the perspective that rates will be in kind of a higher for longer position. So the question becomes, who's right? Is the consumer right? Usually the consumer's wrong, and the bond market is a little bit more accurate, but the bond market over a long run is typically also wrong. There's a whole bunch of charts that show like basically your rate path, and then the bond market forecast just shooting off of it, and it shows like how wrong it was historically. And so probably the truth is somewhere in the middle, and somewhere in the middle to me looks like, as it stands right now, we have a set of circumstances in which it would be reasonable to assume that rates would stay higher for longer if the set of circumstances doesn't change. But the set of circumstances is very likely to change. We have a trade war that's putting a ton of pressure on the U.S. economy. We don't have data that substantiates the impact of that yet. We have a global economy that isn't doing well. China just put in, I think, $700 billion worth of $700 billion USD equivalent of liquidity into their market yesterday through quantitative easing. And so I'm of the opinion that the global economy isn't really in a good position, but there's no data to back that up yet. All of the metrics that would convince a central bank that rates need to be lower aren't there yet. And in Canada, they're becoming absent as well. We had a really strong job print a couple of days ago. We had a strong CPI print a couple of days ago. And there's still concern that inflation could pass through from tariffs. So this is why the Bank of Canada is probably not going to cut in July. Will they cut several more times towards the end of the year? Probably. My guess would be that rates will be lower at the end of the year than they are today. But the path to getting there requires a couple of things to break and go wrong, and we just don't have those readings yet. So the question is, when do those appear? I'll skip this, but it's just basically just how the neutral rate has changed a little bit over time. This comes from TD Economics, who indicated that there's less pressure on this like mortgage renewal wall that we've been talking about. I think Bank of Canada actually put out a study today on this. If you just search like mortgage renewals, Bank of Canada, it should come up. It was just a staff note, but it shows that now we're at the point that by the end of 2026, only 1/3 of mortgages will renew at a higher rate. So what went from, before the cutting cycle, 100% of mortgages by the end of 2026 renewing at higher rates, and many of them renewing at significantly higher rates that would really have destroyed the household finances of many people. That has kind of disappeared, which is a good thing. And so that'll probably, the likelihood of there being a lot of distressed supply that would have appeared prior to the interest rates coming down was probably a lot higher than it is now. So your mortgage debt payments are actually trending lower for individuals than higher. And so the mortgage renewal wall has softened quite a bit, and the ease of actually passing through it for the economy is probably a lot easier than it was prior. So that's good. The bad part is that our debt levels are still astronomical. I'll skip through this one and kind of jump over to here where it's actually even more fascinating. It kind of shows us that, so this is your change in average mortgage debt by age group, and actually baby boomers. So the group of people that you wouldn't expect to be the ones that are piling on debt are the ones that are piling on debt. So you've got your older people who have equity in homes, who have spent a lifetime saving money. They're actually increasing their debt load more than your under 45, let's call it. So anyone 55 plus so that's your gray line and your black line here. They're increasing their debt load faster than everybody else. There's a lot of reasons why this could be the case. Because many of them are retired, they're not as tethered to the inflation environment, and so they're not getting passed through of inflation to their wages, and they might actually be using debt to solve for the inflation issue. Another thing that was pointed out by some of my colleagues, like Ron Butler and Ben Rabideau, was that we're seeing a lot of people co-signing mortgages for their kids, which would obviously be an instant increase in their debt load on paper, even if it's not technically their debt. And we're also seeing people taking HELOCs to give gifted down payments to young people. So these are ways that Canadians are dealing with the housing crisis. And CMHC's data actually observed the same thing, in such that 41% of down payments for first-time home buyers came from gift or inheritance. And I think it was something like 58% of people, no, it was less than that, but anyway, it was some really remarkable number of people had somebody on their mortgage other than their spouse, which is most commonly a parent who's co-signing. And so this is another reason that probably older generations are increasing their debt load faster than the younger generations. Younger generations, to be honest, after that peak in 2022, when everyone was chasing houses and levering up and taking on as much debt as possible to buy houses, they really hit the limit of how much debt they could take, and so they've actually reduced their debt load since. Also known as deleveraging, and deleveraging is really it's part of the process that we really need to go through as an economy in Canada. But I'll get to that in a second. Mortgage service costs. So we went to payments. Mortgage service costs have kind of settled, but they're higher than they were obviously during the pandemic, but also prior to the pandemic. And so that's going to have some stress, some downward pressure on the economy, because if I'm paying a mortgage that's $3,000 a month now, and it was $2,000 a month in 2019, that's $1,000 a month that I'm not using to hire people or spending at stores or putting in savings and investing it. And so that's kind of where the long-term draw of higher debt service costs appears in the economy. I'm going to do a little bit of comparisons here just in household indebtedness. So Canada is the most indebted country in the world on a debt to household income basis. relative to assets, we're a little bit better because Canadians have pretty high or inflated assets due to housing. But our debt per capita compared to the U.S., and you can see the U.S. going through their period of deleveraging here in the global financial crisis. Basically, their debt load peaked in 2007. Every other G7 country went through the same thing. Like any other G7 chart, except for maybe the UK, that doesn't. It's kind of flat after that. Most of them, they stopped going up after 2008 for a period of time, and then they kind of sobered up, right? Their party ended in 2008. As you can see here, ours just got started. And that was when Canada first dropped our overnight rate to 25 basis points. So I'm just reading this question here to make sure that you understand. China doing quantitative easing, you mean they dumped U.S. Treasury bonds? Thanks. No, they injected capital into their market through quantitative easing, which would be domestic purchase of bonds from their central bank. To return to this one, household debt per capita in the U.S. obviously started climbing again, but Canada just like didn't stop climbing. If you jump that over to all these charts come from a guy named PH Floor on Twitter, by the way, where I encourage you to follow. The household ratio of liabilities to net worth in Canada, this is where you are starting to see some sort of, I wouldn't call this a deleveraging because I think that the income piece, which is what we use to actually pay for our debt servicing, is probably more of an important piece of the puzzle than our assets, because you can't really pay debt with your assets unless you sell them, or maybe borrow against them, but then you're taking debt to pay debt, so it's actually an increase in leverage, not so it's relative. But the U.S. has seen a much better improvement in household liabilities to net worth compared to Canada. All of this to say, Canada needs to deleverage. This is another chart from Twitter. The account's Red Pill Rick. But Canadians have been deleveraging. So we peaked at 185.4% debt to disposable income, which is literally a world record. That's the most that anyone's ever achieved. And this to me is like really just a huge indication that Canada is a debt fueled economy. We're obsessed with it. We use it to, I always call it debting ahead. I mean, you go to like other places in the world, not everyone's driving a nice new foreign car. Not everyone's living in a McMansion. Canadians just love using credit to make our lives marginally better. We suck at deferring gratification. We want the best life that we can have now, and we'll suffer for the rest of our lives to pay the debt that we accumulated to do that. It seems like we have realized that was a bad idea, and that eventually the party and the music has to stop. And Canadians have now decreased their debt load at the fastest rate that they ever have, other than the pandemic, during which point basically everyone got helicopter money and didn't have to pay their mortgages. So it stands to reason that we decreased our debt load at that period of time. But so Canadians are deleveraging, and that's a process that's going to continue and going to have to continue. And I would really look back at what those deleveragings look like in countries like the US, or look at the global financial crisis, look at Canada in the 1990s, and look at what that happens. This is a deflationary process. So Canadians are going to sell assets, houses, cars, boats. If you're like me and you've been looking for a boat on Kijiji for the last like 5 years, and COVID, you saw the prices go up like crazy, and now you can get the same boat for like 50% of what it sold for. That's what deleveraging looks like, and that's the deflationary impact of deleveraging, is people getting rid of stuff so that they can pay off debt. I'm going to jump over to house prices now. So does anybody have any questions in regards to everything I covered on debt? Okay. So house price momentum in Canada is basically flatlined on 3, 6, and 12-month moving average. All of them are below zero. So house prices are trending down, and that's at a national level. The problem is a little bit here that we the house prices in Alberta, let's say as an example, like the different areas, there's a huge range geographically. Ontario and BC make up like 60% of the average house price, or the like index, and so those indexes really get pulled down by activity that's happening in Ontario and BC. Ontario and BC are really suffering. They're seeing like huge drops in house prices. Everywhere else is really kind of fine. Actually, most of them are seeing increases in house prices. So I won't get too into the granularity of it. But real estate has really become a geographic story. And so you need to have conversations with the local market professionals and get a good understanding of what is happening at your local market. And that's probably what's going to help you find opportunities in a market that's incredibly difficult and scary from a real estate perspective. Home prices, I'd mentioned kind of like after the drop that they would grind sideways, and they have for a long period of time, and they've kind of started grinding down, pretty much a repeat of what we saw in the 1990s. There's a handful of charts out there, one on Exelon's Substack that's pretty good. I think BMO Economics did one as well that maps all of the past housing corrections side by side, and we're basically exactly on track to repeat the 1990s housing correction. Do I think it will be as low and painful? It could be. Yeah, it really depends on probably the outcome of this trade war, which I'll get to kind of towards the end of this. From a supply perspective, so months of inventory is really high. It's like high relative to what we've experienced in the last little bit. But if you really go back, we're kind of in a normal market. So we're in like sort of the market that we saw from early 2000s until basically the pandemic, other than like a couple of crazy moments. Market balance, I would say at a national level, we're basically in a balanced market. There, you can kind of look at that geographically a little bit better. And this gives you a deeper perspective of just like how skewed that impact is of Vancouver, Ontario, Vancouver and Ontario, basically. Toronto, Barrie, and Windsor and Vancouver are basically the only buyers markets in the country at this point in time, based on the sales to new listings ratio. You've got a couple that are kind of in balanced market territory in Ontario, so like Kawarthas, Hamilton, Burlington, and then basically the remainder of the country. So your entire East Coast would be in sellers market territory, as well as your prairies would be in sellers market territory. So again, like the easiest way to think about this is that markets that are affordable, like your prairies especially, where basically people with a normal income can afford to buy a house, they're behaving like normal markets, because when people can afford houses, they buy houses. And this is the problem with Ontario and BC, is people can't afford houses there. The price to income level is really bad. So any improvement that we're going to see in the number of transactions in the housing market is going to have to come from prices continuing to fall. It could also come from interest rates falling or from wages going up, but those two things are, as it stands right now, not going to change in the near future. And so at least in the near future, until those variables change, we see an improvement in wage growth or improvement in the interest rate scenario, house prices are going to have to do a lot of the work to create affordability, to get more transactions going, which is why I've always found it funny that realtors kind of want to see house prices go up, because if prices go up, fewer people can afford the houses, which means fewer people buy and sell the houses. This is RBC's analysis. They have Canada in a balanced market as well, and that home price index with prices falling below. So they have them down just shy of 4% on a year-over-year basis. The one thing that I think is really worth paying attention to in Canada's housing market right now is whether or not builders and the demand created by this new first-time homebuyer incentive is capable of creating more demand, or if they're capable of finding an equilibrium in the market. So if you look here, this shows basically your house prices and the impact of this new GST removal program, GST rebate program. And so basically up to $1 million, first-time homebuyers pay no HST. So they actually get like a $40,000 or $50,000, let's call it like an advantage or a subsidy on the price of new homes. And so what we'll likely see is builders really pivoting more and more towards building homes for first-time homebuyers, which is like, this is really kind of the first time ever that you would have seen this, probably since like the last time this happened in Canada's economy, like the 1990s. Or like, yeah, when we had like 0% down programs and stuff like that, because builders could make a lot more money selling condos to investors or houses to move up buyers or foreign investors, as an example. And so I think that this has the potential to drastically change the housing market, probably more than anything else I'm discussing today, is how this whole thing materializes. And what it looks like from my perspective is probably like, we're going to see a lot more townhouse, stack town product, maybe some more, less like Airbnb style or Airbnb size condos, some more like comfortable, potential like couple sized or even family sized condo units, stack towns, townhouse product. And this is all good. These are all good things, by the way, but that's going to have a pretty big impact on the market. I will mention the rental market as well, because I think rental is like that's its own beast and it's very worth watching. But on the new build side, I think you're going to see 5 years of builders basically purely tailoring houses to first-time home buyers, if they can. It's a hard market to sell into because first-time home buyers are not the richest buyers in the market. The policy savings that are going to happen as a result of this HST thing are going to be most pronounced in your most expensive markets, where you have more and more of those houses that are up against that kind of $1 million mark. So in Toronto, for first-time home buyers, you're going to see a reduction of like $250 a month on a mortgage payment and up to $10,000 reduction in their down payments. And this is based on assuming a 20% down payment on newly built homes. This is all analysis from Desjardins, by the way. And Vancouver would have the fewest number of homes that would qualify for the GST rebate, even though Toronto or GTA, they would call this. Toronto has a lot of condos that are below that number. They also mentioned that rental apartment construction continues to outpace condo construction in Canada, and this to me is, outside of what I mentioned, the new build trend and kind of how that's going to shape the housing market, this is probably the biggest risk factor for the housing investment in the Canadian economy right now. So rental construction is past condo and ground oriented, which is like your single family detached. This is the ratio of rental housing starts to condo starts. Probably one of the most shocking graphs in Canada right now. Now remember your condo number is trending down and your rental number is trending up. And so that's why it can kind of rise very sharply. But rental housing stock is the highest we've seen since like the 70s. Like you kept hearing policymakers fantasizing about the 70s, talking about how it was such a great time for Canada. We're building so much high quality rental housing. We got back to that very quickly. And the big reason for that, obviously, is CMHC's MLI Select, which I'll get to, and I'll show you some interesting data on that. But they've made it really compelling for people to build rental housing. I was of the perspective that Toronto probably would see less and less of it, or the GTA would probably see less and less of it, because MLI Select projects don't really pencil as well in the GTA, but it's just as high or just as meaningful of an impact in the GTA as it is in other markets. So we are seeing a huge increase in rental construction. I'm going to get to kind of what markets are most vulnerable to that and how it kind of plays out. But to the point where CMHC for the first time ever in 2023 is now has more dollars insured of rental housing stock than they do of homeowners. And so when we all think of CMHC, we often think of like first time home buyer product that you buy if you want to get 95% loan to value mortgage, or only put 5% down or 10% down. And that would be like their homeowner product. Their rental product is mostly MLI Select. I actually have a chart here. You can see basically their rental apartment program. So this is structures with like that you would call your multifamily housing. So five or more units. I think like 80% of it is coming from MLI Select, and 88.4%. So almost 90% of all rental housing right now is built using CMHC MLI Select. So they've basically created a market overnight, or well, in the last couple of years. You can see they started creating that market in 2022. They doubled it basically in 2023, and we're almost at triple what it would have started at. So that's having a massive impact on the market right now, to the point where, again, CMHC is this rental housing powerhouse. They're insuring a ton of rental housing. They're going to continue to do so. And this is good for Canada. Like, this will help us improve affordability. So you've got here, if we can actually meet these housing supply targets that the government's been talking about, the housing affordability would improve by like 10 basis points. So that would make housing basically like on if we're 53% mortgage payment or mortgage payment as a percentage of household income, and you drop that to 41%, it would basically reduce the payment burden of people relative to their income by 20%. This is good. Like, this is the problem, I think, that a lot of people, a lot of developers and investors aren't thinking about, is that they're the ones who are eating that cost, because their rents are going to fall and their vacancies are going to rise. And I'll get to an example of what that looks like from CMHC in a second, but this is where this whole thing gets a little bit more scary. And I'm just gonna I'll answer Dwayne's question. How far down has price dropped since the peak of early 2022? I think we're at about 18% at a national level. Depends on the market. Like GTA would be down 22%. Vancouver's 25%. But nationally, I think we're like 16 to 18%. It really depends if you're using average, median, or index. Okay, so rentals under construction is a share of total rental stock. So this is a graph that shows you all that rental supply that I just mentioned. If you take the rental supply that's under construction right now and divide it by the number of houses that are already available for rent in that market, this is the number that you get. So in BC, almost 15% of their rental housing universe, the rental housing supply, is under construction right now. In Atlantic Canada, it's over 12%. Alberta is over 8%. Saskatchewan's just shy of 7%. At a national level, we're building 6% of our rental housing stock. So if immigration population growth stays at zero, which isn't going to happen, but hypothetically, if it stays at zero, you don't see any increase in demand, and all of this rental housing gets added to the market, and we see limited new household formation. So you don't see, a lot of the people who are maybe roommates right now, four guys renting a room and each one's paying $1,000 a bedroom or whatever, or four guys renting a 4-bedroom house, each one's paying $1,000 a month. Super common housing format, by the way. Roommates are the fastest growing housing type in Canada. If those individuals aren't going to, go get their own place and spend the $1,500 or $2,000 that they need to change their housing situation, then this is literally just a pure increase in the vacancy rate. And that's scary, right? It's especially scary because it's not going to materialize as a pure increase in the vacancy rate, because some people will form new households and some people will move out of the roommate arrangements, and rents will come down so that the guys who are renting a bedroom for $1,000, maybe they can get a small apartment for $1,500 in their market. And that makes it compelling, or makes the economics of them leaving their house good enough that it's worth doing, and so they do it. But for the most part, demand isn't going to catch up to that supply, and real estate always does this, right? Because we underwrite projects on the assumptions of today, but it takes us 4 years to deliver the projects on average. And so people were underwriting these deals using 2021 vacancies, 2022 vacancies, 2022 rents. And then by the time the project completes and they're stabilizing and they're trying to do their lease up in 24, 25, 26, the assumptions are blown to bits. And here's a good example. So if we go over to another chart from CMHC, this shows, this is Calgary's market. And Calgary, I would say, was really like the first mover on the CMHC MLS Select stuff. Mostly because you could get their affordability points entirely by just like putting basement apartments in the unit, because their incomes are so high relative to rents in Calgary. So people would build like a townhouse block of, I mean, there's probably people on this call who have done it. And I have a lot of friends and investors that we've worked with that have done a lot of this stuff. And we're doing it really well in 22 when the program first came out. You build a block of 4 townhouses and you put basement apartments in each of them. And the basement apartments already qualify you for all of your affordable rents. What happened is this worked too well. And a lot of people were doing it. And so your vacancy rates in 2023 were like 2% here. And so if you were contemplating a CMHC MLI Select project in 2023, you're underwriting at 2% vacancy. By the time you went to stabilize, and this is your 2015 plus product, so this is your brand new product, you just need to be looking at these 3 bars on the right-hand side of the chart here. If you were underwriting in 2023, you were underwriting at a 2% vacancy. By the time you closed and went to occupy, you were stabilizing in a 7% vacancy market. And so in order to move your product, you were probably having to decrease rents, or you were just suffering through increased vacancy. And this is a very good example of what will happen in pretty much every market where we are seeing this supply. And I don't want to call it overbuilding, because I don't think we are overbuilding. I think we're building enough supply, but it just hasn't been rolled out in this long, slow, trickle that we needed to see for it to get absorbed by the market. It comes in chunks, and a lot of this is the size and scale of projects that we're delivering. Like Toronto, as an example, you're seeing 50,000 condos closing this year alone. That's going to have an impact on vacancy rate. Plus, you have all of these MLI Select projects, all these rental buildings that are closing in the city of Toronto. So I think that vacancies will probably 3x from their lows. We saw lows at like 2% vacancy. It would not surprise me to see 6% vacancy rates in many markets in Canada in the next 2 years. Yeah, Corey, it's a great question. I would say, so the question is, should we be concerned that there's so much rental stock being built with the CMHC program that is a government-backed program? I am of the perspective. So these delinquency rates for multifamily are pretty low still. They actually trended down year over year as a percentage. They trended up on dollar volume, but their insurance book was much higher. I'm not concerned as a taxpayer. CMHC is like the only government entity in Canada that makes money, and they make a stupid amount of money, like insane amounts of money. They have, like, if you look at their annual reports, they are a cash cow, and they just increase their premiums, and they did that to try and compensate for the risk that they're taking. And they've made a lot of good moves as an insurer. We have to remember they're an insurance company. Like, that's the product that they sell to get housing built. And so they de-risk wherever they can. So they de-risked in a handful of different ways over the last year. So in Ontario, if we go all the way back to like last year, they got rid of the point system. So they reduced the points that you could get from energy efficiency from 100 points to 50 points. That wasn't necessarily a de-risk, but that was more along their mandate of trying to get affordable housing built. Because in Ontario, as long as you built to Ontario Building Code, you got 100 points. And so if you got 100 points, you could get the highest loan to value, the best interest rate, and the longest amortization. And you didn't have to build any affordable housing. So they weren't accomplishing their goal of building affordable housing. But what happened since then is that this has really become a product that's been adopted, loved a little bit by the Toronto pre-construction investor community. And I think that they like to turn things into a casino, right? And so I think CMHC saw that there was a lot of product that was being delivered in the wrong way and to the wrong people, and the wrong people being basically investors who they didn't like the risk profile of. So they de-risked this in two ways. Number one is they created something called the rental achievement holdback. And so the rental achievement holdback basically makes it so that if you end up in this situation like I just described here, where you're going from a 2% vacancy to a 7% vacancy, and if your income was supposed to be 100 grand and now it's at 70 grand, your net operating income was 100 grand and now it's at 70 grand, they would reduce your loan by the exact same amount. So if you're now at 70% and you were supposed to get 95 LTV, they'll reduce your loan to 70% of what it was before, until you can hit that rental, until you can achieve that rental, the amount that you pro forma. So that's a rental achievement holdback. So they de-risked that right away. Is that going to blow up some projects for some people probably who underwrote a little bit too aggressively? Yeah, 100%. Is that the insurer, the taxpayer's problem? Not really in that situation. Number two is they started requiring, because I think they were getting borrowers who probably didn't have the staying power to hold projects like this. Getting a lot of those pre-con speculators piling into these projects, getting excited about them because they're 5% down. CMHC required that you have to have a 25% cash contribution or visible cash sitting there during the construction period, so that even if you're only putting 5% down, if something went wrong with the project, you would have enough to call on to make the project whole, so that you don't have to go and find some mezz lender or private lender to go behind CMHC so that you can just afford to close the project. So I think I'm honestly not concerned as a taxpayer that CMHC is overexposed to this. I actually think that they are doing a pretty good job at managing the risk away, and I think that they're making money for us as taxpayers, and they're one of the only entities in the government that's doing that. So I would encourage them to keep doing it. And they're making housing more affordable. I honestly think they're doing a pretty good job at that, but by flooding the market with supply. But that's what we wanted, right? That is literally what everyone was saying. We need to build more houses. Okay, we're doing it. Now we're doing it. We got to suffer the consequences, right? The consequences are rents fall, vacancy rates rise. Where am I? Housing starts to population growth were way below what we're typically building at. So this is population growth divided by housing starts. So this is the lowest population growth that we've seen relative to how much housing we're building in as long as we've been able to measure it. This is good, right? It's obviously not going to last forever. Like right now we're seeing zero, if not negative population growth, because the government is trying to get non-permanent residents down from 7% of the population to 5% of the population. And so you're kind of getting this point where there's a handful of different, I'll try and wrap this up quick too, because I just realized I'm going a lot longer than I intended to. But, basically a lot of people are leaving because it didn't work out for some of the temporary foreign workers or international students. The economic promise of Canada wasn't exactly what they expected. And policy has also been trying to remove some of these individuals by not renewing visas, or by taking them from a non-permanent stream and turning them into a permanent resident. So giving them permanent residency. And so you're getting a lot of people added to the permanent resident or immigration that are coming from as a loss in the non-permanent resident. So the majority of our immigrants to Canada or permanent residents being added to Canada actually are already here, right? They're just on a different type of visa and they're being added to the permanent resident stream. I'll skip that one. The one big issue and this is where I really think that when I think about CMHC MLI Select and when I think about rental housing starts, the government does want to keep the machine running, is the construction sector jobs are really a big issue. So construction sector jobs, we've seen a ton of condo projects complete. There's no new condo projects being started. If we see huge unemployment in the construction sector, this becomes a recipe for disaster. So I think that they're very incentivized to try and keep housing construction moving through programs like CMHC, MLI Select. I mean, housing is really infrastructure, right? We need to treat it like infrastructure. And so you go back to the 1990s or 1980s and look at what happens during recessionary times. The government spends a bunch of money on what they call make work projects. Make work projects are basically like you're spending a bunch of money to make work, to keep the economy moving. And we're really seeing Carney pull back a lot on OPEX spending. So they're going to be laying off a lot of government workers to try and reduce that bloat, but the ongoing expense. And they want to reallocate a lot of that money to capital projects. So if you're a real estate investor or any type of investor and you think about the way a company runs, governments run the same way. They have OPEX, operating expenses, and they have CAPEX, capital expenses. CAPEX improves the value of your company, your house, your rental property, whatever it is. That's where the government is really going to be trying to focus the capital over the next little bit. This is, again, another little bit of a downside risk from the rental market side of things, looking at non-permanent residents. So non-permanent residents and rents or rental inflation correlate very heavily, as you can see. And because we're seeing non-permanent resident population falling, you can see it coming down the blue line there. Rents are going to follow that line. I don't know how far down it's going to follow them, but rent CPI, and this will pull CPI down too. This is probably where we're going to get to the point where we're in a disinflationary environment a year from now when these rents falling actually show up in the market, right, in the consumer's basket of goods. And so this to me is like a big component of like right now, shelter inflation is like, I think it's like a third of overall inflation. So if like CPI is at 3%, like 1% of that is shelter inflation, which is your mortgage costs and your rent CPI. And so if that drops to zero, which it will, once we're past the renewal wall, we just learned that only 1/3 of people are renewing at higher rates. We pass that renewal wall, plus rents past that renewal wall, we will be in a disinflationary environment, if not like well below target or almost on the low end of the target range, probably within 6 months. So that's kind of where the Bank of Canada starts getting a little bit more runway to cut. As it stands right now, are they going to cut? Probably not. They're not going to cut at the next meeting. Maybe if we get some bad U.S. economic data or the Fed starts cutting and they get a little bit more room, they might pick up the pace toward the end of the year. But as it stands right now, until a lot of these things materialize, they really need things to break, right? So they can kind of come out and say, okay, we're going to fix it, right? Here, we're going to drop the rates. But what they shouldn't be doing is the moral hazard of trying to prevent people from suffering the consequences of their own actions. And that's really the delicate balance of being a policymaker with the central bank, from my perspective. Tariff rates, your effective tariffs on Canada are relatively high right now, mostly concentrated in Ontario. And so you're seeing a little bit of a suffering in the Ontario market as a result of that. Trade war thing, I mean, I think the market's kind of priced it in, I would say. I think the housing market hasn't really, but like your stock market has like very much like priced in trade war. And it's almost, we hear about the taco trade, Trump always chickens out or whatever it is. Like people just aren't taking this seriously anymore and think that it's going to come to an end. I'm of the alternative opinion that, like, if you listen to Secretary Bessent speak, he did a podcast with All In, and he really talks about tariffs as a revenue tool, and they're very serious about it. So I do think that there will probably be some sort of lasting impact. Where do we fall? I think we're probably going to fall in that like 10 to 20% range. You're seeing a lot of these things. I said from the start, as soon as this was announced, it was going to be exactly like 2016, where it was going to be a bunch of posturing around tariffs, but then eventually it ends up being basically everything's exempt. There's like 70,000 exemptions for Canadian, like specific exemptions in the Trump 1.0, so the 2017 Trump administration. I think we're going to end up with the same situation. It's just how long does it take to get there, and how much of that passes through to the consumer in that period of time, and what are the impacts of it. And that to me is really the X factor that we've never seen the central bank have to deal with so far, which is they're really just tightly monitoring how bad these, and you can see it on the Bank of Canada's website. Like, they did a couple of studies on it recently, but the risk of pass through of inflation to the consumer. And so there's a lot of stuff that I think they're paying attention to that's made them kind of a little bit fearful to cut rates. So I think that's everything I have for today. Is that my last slide? Yeah, that's my last slide. But I'm happy to do some questions or our little fireside chat, Corey.
Yeah. All right, let's get everybody back up here. Wow, that was a lot. Holy smokes.
If anybody thinks the economy is simple, it is not.
It's very complicated stuff.
Okay, so I just want to thank everybody who followed Dan here and hung out with us. Lots of questions that I've got. I know some of you may have some questions too, so put it in the chat and we'll pop it up on the screen. We'll get Dan to answer those questions. But in the meantime, I know, Corey, you're really big on the economy. You geek out on this too, so I'm sure you've got a bunch of questions stewing in your head. If you want to kick us off, let's go. Let's do this.
Well, what are your thoughts there, Daniel, on, like, I know we're very tied to the U.S., so like all the tariff things aside, I think I was watching one of your recent posts that, really like the U.S. has to drop their rates before our rates will come down, and a bunch of other factors. So maybe you can talk a little bit about how that plays in to things. And I'm kind of surprised that the U.S. economy is still chugging along really well. Like, do you feel like they might hit a wall at some point as well, or?
Yeah, so probably, but it really depends. Like, I mean, the stock market and the economy are very different things, right? So the stock market is ripping still. And I would say, seems to be like super overbought based on a handful of metrics, which somebody mentioned in the chat here as well. If you look at like the Buffett index, or there's a handful of different like PE ratios of like ways to determine how overvalued the market is. There's a lot of speculation, right? I think there's a lot of money to be lost there. But I don't think the central bank really cares all that much about that. What they care about is inflation and employment, right? They have a dual mandate. The Bank of Canada has a single mandate, which is to keep inflation in the neutral range. The U.S. central bank has neutral inflation and full employment. Both of those things are still kind of there. U.S. inflation has come up a little bit, and so again, this is kind of concerning. This is probably a pass through of tariffs in the U.S. where people are actually paying those tariffs, and that gets passed through to the consumer. So it actually ends up backfiring a little bit. I would say that, do we need to wait for the Fed to cut? We either need to wait for the Fed to cut, or we need to wait for something bad to happen in Canada's economy. I mean, if we look back at what happened to the Canadian dollar the first time the Fed cut, the first time the Bank of Canada cut before the Fed, Canadian dollar got smoked, right? It was really only once Trump started doing all of this stuff and the U.S. dollar started to weaken relative to other currencies around the world that the Canadian dollar kind of came back, and that wasn't really because of us or because of the Bank of Canada. So the easiest way to think about this, if you're trying to understand it, if somebody's listening, your interest rate is like the rate of return on a currency, right? So if the interest rate in the U.S. is higher than in Canada, then people are willing to pay more money for the U.S. dollar than Canadian dollar because they can get a better return. And so if Canada cuts too far ahead of the U.S. and our rate of return or interest rate on our currency is significantly lower, then Canadian dollar loses favor. The risk that comes from this is that if we lose a lot of buying power against the USD, then we're at risk of what's called imported inflation, because Canada buys most of our goods in USD. And so if we lose 10% buying power against the US dollar, our goods basically go up by 10% because we buy almost everything in USD. And so this is probably one of the scenarios that causes the Bank of Canada to not want to lead the Fed too much, and why they've probably slowed down and why they would be waiting for the Fed to do it. I do think the Fed will cut probably in September. I mean, if, like one bad jobs print won't do it, and one really low CPI number probably won't do it either. So I think we're waiting for the Fed, to be honest.
Gotcha.
So I got a question here, because you mentioned about, the stocks doing well, especially in the States. Corey and I had a conversation actually with Dwayne Moore earlier today. It was just coincidental. So we were talking, I was talking about the economy when we're on the phone. I don't know if we talk or rant, but in any event, we have a conversation about that. But so here's the conversation that we had, and I wanted to throw it out there and get kind of your insight on this, because everybody's saying that we're in a recession. So I guess the first part of my question to you is, would you say we're in a recession? And the second part is, how can we be in a recession when there's inflation happening? Because usually they don't go hand in hand.
Well, yeah, I mean, yeah, we're not really in like an inflationary environment. Like core is higher than the Bank of Canada wants it to be, but like CPI isn't technically out of the neutral range. So I wouldn't say we're in stagflation. If we are, it would be like very minor. But technically, if you have inflation and recession, that's the situation that you're in. Fortunately, like a recession has 100% success rate with getting inflation back down to the neutral range, right? Like if you really want to get inflation back down, the easiest path to do that is a recession, and that's often why the central banks will keep rates higher for longer to push the economy into a recession. Like central bankers don't really care if people took on too much debt and now can't survive. Like, you know what I mean? Like most people who were responsible, levered up properly, made decent financial decisions, like they're not really suffering in the grand scheme of things. And so people who scaled too quickly, made stupid financial decisions, suffer as a result of rates being too high for too long. The people who they are more likely trying to protect, and who knows why, right? My guess would be, if you, the people who it's basically people below, let's call it like your middle class, right? Those are like, if you think about the way inflation works, people who are poor, they live hand to mouth, right? So they don't feel inflation, right? Because they get a dollar and they spend the dollar. And so the dollar that they're receiving and spending are both subject to that inflation. The rich benefit from inflation, right? And so the rich hold assets, stocks, real estate, whatever. And so inflation actually increases their net worth. And so the people that they are trying to protect from a policy perspective, and protect is probably the wrong word, but is the middle class. Because if the middle class holds assets, but not a high enough amount of assets to see their value go up and it makes them more wealthy, what happens is that their wealth actually gets inflated away. And that makes people very upset and angry, right? If people feel worse off every single year after year, that's how you see major political shifts. That's how you see revolutions happen, right? As disparity starts to increase. And so that's kind of what central banks are trying to do. I think that's what they're trying to temper, right?
Gotcha. Yeah.
And I guess I didn't answer your question. I apologize for interrupting you. Are we in a recession? Technically, no. But a lot of that's because Canada has grown our population so substantially that we have more people consuming, more people earning wages. So it's a very easy way to grow an economy if the number of people is growing, right? It's like a business. Like you keep improving headcount, you keep bringing on more customers, the business is going to continue to do better. But relative to the population or per capita, we've been in a recession for like years, like I think 9 or 10 quarters now, right? So 2.5 years. Then I call that a me session, right? So on an individual basis, you and I don't feel like our economic lives are probably improving. Most people would say that that's the way that they feel. But technically, all of us put together as an economy are actually moving up. And it's because there's just more of us, even though there's less economy per person.
Gotcha. Yeah, it's so hard. I think it's just so hard for everybody to like try to wrap their heads around because they also change the data. I mean, how they qualify it, sometimes they're putting in certain things and taking out certain things, and it's like when they're calculating the GDP, and I don't know, it's just really frustrating to watch. I will tell you, like, I think they intentionally. Sometimes I feel like they intentionally try to confuse us. That's what I'm gonna say.
Oh, probably, yeah. I mean, I think that if most consumers had a strong understanding of how the mechanics of the market work, that they probably already would have had a revolution in most Western economies, right? I mean, in Canada, like you create money by taking a mortgage, right? So,
Yeah,
yeah, it's all just like it's all magic. So
that
I
was
think
really
you're right. They want to mystify it.
that was really eye-opening too when you said that about how we're just such in a debt. We're the biggest debt country, and that actually was an eye-opener. So thank you for sharing that. I want to go
Yeah,
to questions here with the audience because we're running out of time. I want to make sure we get
yeah.
some audience questions in here. Arturo was asking, and this is a long one. I don't know how this is going to show.
Yeah,
Yeah,
I can summarize it. Basically, off-market deals are looking for there's a disparity between the purchase price and what it's appraising
well,
for.
the thing is, though, I want to say it's not just off market deals. I mean, we have our students going and looking to get mortgages at the banks. And there's a huge difference between what the appraisals are at and what the purchase price is. And I'm just not sure, like, how are we going to navigate that moving forward?
Well, I think we're in a buyer's market, right? So I would encourage people to exercise the rights that they have from a buyer's market, which would be you're finding like in a normal market, like banks would appraise, and like when I'm saying normal, I'm going back like 10 years now, but banks would appraise deals during the financing condition period, right? Like you can make that happen. And if the seller like of the property doesn't want to see that happen, then just go move to the next deal and keep going until you find a vendor who will let you do that, right? So in your 5-day or ask for a longer financing conditional period, 10-day financing condition period, and you got a 10-day financing period. Now, okay, I can get my appraisal done and I will pay you. You make your purchase price whatever the appraised value is, because that's like the banks. It's funny because people think buyers and sellers determine the prices in the market, but realistically, the banks determine the prices in the market, right? Based on how much credit they're willing to give out. And right now, we're in a very tight credit environment, especially on the acquisition side. So I would say like the easiest way to do that, to de-risk that, is honestly just make the deal conditional on appraisal. And if the appraisal comes back low, then don't pay more than what it appraises for.
And I've heard of situations where, let's say if somebody's bought a condo, right, and now it's upside down on appraisal. Many times, either the builder is willing to work with you, or the bank's willing to work with a new appraisal to make things not look as upside down.
Yeah, for sure. I mean, like everybody's trying to get the deal done in today's market, right? So but like as the buyer, just remember that you have what the scarce asset is, which is the willingness to purchase something. There's less of you than there are properties for sale. Whereas, in 2021, sellers were the scarce asset. It's the opposite now. And so I would make vendors fight for my bid.
Love it. Got a question here from Marshall. Is there any fallout we should be aware of from the big, beautiful bill?
No, I think that to me, this opens the door for more fiscal room for Canada, right? Or just this is inflationary impacts, right? So this is government spending that is going to, they're already probably trying to soften the blow of the recessionary forces that are happening in both the US and Canada, right? And I know Dwayne asked, like, how is this not a recession? I mean, technically GDP hasn't been falling for 2 quarters, and that's the stupid framework that policymakers came up with that defines a recession. By every other metric, yeah. I mean, unemployment's rising, delinquencies are rising, bankruptcies are rising. But to me, like, big, beautiful bill and what Carney's talking about with all of this spending on infrastructure, these are like recession era policies that are trying to stimulate the economy through growth. So I don't think that there's fallout. I think that it's probably an admission that a recession is either here or on the horizon, and it's an attempt. And so I would just adjust your bets accordingly. And the way that usually looks is like, once this kind of stuff starts, there's usually a really bad period, and then you kind of see a bottom, and then there's a really gradual increase, and it never shoots up out of a recession, right? Because it takes a long time for people to get their confidence back. So you can kind of start observing that recovery really early, and just pay attention. Like a lot of people who have a higher EQ, like I'm like a nerd when it comes to charts, but I have a pretty low EQ. Like just kind of keep your ear to the ground on like what people are saying on Main Street. Like, how are people feeling? Are they feeling confident? Like right now, you can't find people to buy houses, right? And 2 years ago, 3 years ago, they were lining up to buy houses. Now you can't find anybody. So that would tell me like when there's like no bid left, when you have to give away your house to get a sale, then that's probably when we're pretty close to the bottom. I don't think we're there yet, but then just remember how long that confidence will take to get restored.
So you did say that, if with what they're doing with the tariff wars and everything and the big beautiful bill and all of that, it could be an indication of their admission that there's a recession on the horizon. So do you think there's a recession coming if you're saying we're not there?
100%.
Okay, so
absolutely.
With that being said, are you saying then if there's a recession coming, but you're like, we're almost at the bottom, so typically a recession means we're going to dive more. So do you think we're going to dive more?
Well, when I say almost, like I mean like years, right? Like a bottom in like historic terms, like if you go back and look at the 1990s, like the bottom of the market was like 2 years long and very flat, right? So that's probably what, like, are we almost there? Yeah, probably. What happens when you're actually there is like nominal prices stop falling, but if they go sideways, like if you adjust for inflation, like real house prices are down like 40%, right? And in the 1990s, it took from 1989 to 2002 for nominal house prices to recover. But it took from 1989 to like 2012 for real house prices, or adjusted for inflation, to recover. And so what happens is you get to a recession, the central bank and the government, you see both fiscal and monetary side really, really trying to pump up the economy. And that's when you start to see inflation kind of ramping back up. And that's like what kind of stimulates the growth. I don't think we're close to the bottom, like in terms of like in the next 2 quarters, but usually, especially in the housing market typically ends up recovering early, right? Because we've been in a recession. Like if you think about realtors, right? Mortgage brokers, contractors, we've all been in recession for 3 years, right? 2 years probably. Whenever the rate hiking cycle started, people stopped buying houses. Real estate professionals' income dropped like 60% in 2022, and it hasn't recovered. So we've all been in recession for a long time. And the reason why is because we're the most credit sensitive. So when rates went up, people stopped buying our product. And then when rates go down, people start buying our product again because they can afford it. Prices are down, rates are down. The real estate industry recovers a little bit faster. It's not to say prices are going to go up. What should happen is prices will continue to fall, and they'll get to a point where people can afford it. People say, oh, I can afford a house. I'll go buy a house now. And then that's when volume starts to ramp up, and then price follows volume. As you get more into a seller's market, more buyers start to enter the market. That's kind of how the recovery looks. It's not super complicated to see, but the part that scares people is, they go back to the 1990s. Like, why did a lot of baby boomers not like investing in real estate? Well, because they saw what happened, right? There will be a period of time, like we're going through that moment now, where it's going to be hard to find people who are to be excited about investing in real estate over the next decade.
Gotcha.
Yeah.
There's we got 2 questions I want you to just go through real quick because we're out of time. Sure. But I want to hit them fast. So like, I don't know, 15 seconds or less. Steve is asking, based on your construction growth in Ontario at 4 to 5% and decreased immigration, and both of these, by the way, are just kind of getting your input, kind of forecasting. And we all know there's no crystal ball here, but what's your best estimate for rent growth 2026, 28?
Yeah, I say we'll probably fall another 5% in the next year, maybe, and then it'll probably be flat. Like you'll get back to inflation, 1-2% rent growth. So I would say by 28, rents will probably be the same as what they are now, but over the next 2 years, they'll probably fall. So you get 2 years down, 2 years back up.
Got it. And then here's one from Manny Panero. When would you forecast some normalcy in the real estate market?
Probably fall market 2027.
2027?
Yeah, I think so. End of 2027, probably. I think we've got yeah, I mean, 26 is a write-off. Like that's kind of going to be your last kind of grind down. 27 we'll probably see spring market. 27 we'll probably see the bottom, and there'll be an absent spring market similar to what we've seen. But what you'll start seeing is like we've had 2 really bad years, so Q1 of next year, even no matter how bad it is, the chances of it having fewer transactions than this year is very low. And so, because you're coming from a really low base, so that'll start to restore some confidence, right? Sales are up 2%, and then the next year you still have another low base, and you can be, sales are up another 2%, and that's you've got a 2-year positive track record. This is kind of when people start, maybe I'll dip my toe back in. Other people are buying. It's not actually that scary. Banks are lending again, right?
Yeah, for sure. Well, listen, guys, we're 1 minute over time here, so I'm going to throw it over to Corey to take us home. Corey, what's the summary for tonight? Quick, give us a summary. I'm just kidding.
Main summary is you guys got to stay connected to the pulse here, which is everybody on the screen. So we appreciate Daniel making some time for us here tonight. And it's important to be able to have people that can help to interpret the data. It's easy to say that the sky is falling, but there's opportunity everywhere. And we didn't even get into that too much tonight. I really like what Danielle said when it was, talking about it's such a geographical game. Toronto might be a bit of a mess, but that doesn't mean that the whole country is a mess and there's not opportunities all over the place. It's a buyer's market in many markets. So make sure you're staying in touch with your trusted professionals. If you're not following Daniel already, make sure you're following him on Instagram at Daniel Foch. You can also follow his AI brokerage at Valerie.Canada. Follow him on YouTube as well, just under his name. And if you guys aren't consuming his podcast, make sure you guys are on and watching the podcast. So we've got some cool things coming up here at the end of the summer, gang. If people like to golf, we've got our annual golf tournament on September 12th. We'll make sure that everybody that's watching here tonight gets some information about that as well. And can't wait to see everybody. Keep your chins up, guys. I know just talking to the professionals out there in the industry, it's like, real estate might be, not as in favor as different asset classes, but I think this is the time where you can get ahead and tap into some pretty great programs and some pretty awesome opportunities out there. So
it's all about staying connected, right? And staying in the know and just having your finger on the pulse of all the things, because there's government programs and all kinds of stuff that is happening. And really understanding where the economy truly is and where it's going so that you can make smart decisions. And that's why we wanted to bring Daniel Foch to you guys. Dan, thank you so much for tonight. I know you're a super busy guy and you got a lot going on and you're busy raising a lot of money right now. So for your project. So if anybody wants to connect, again, just make sure you connect with him on Instagram and then have a side conversation. Any last final words you want to throw out there, Daniel?
No, I just thank you guys for the opportunity, and hopefully I'll see you at your golf tournament. If you want to send me over some info, I'd love to attend. Absolutely. That. Maybe bring a foursome.
Yeah. Cool. We will absolutely be sending out the details here shortly. I think we're launching it the end of this week or early next week, so it'll hit everybody's inbox. You're not going to want to miss it. Last year was a ton of fun, and we were cigar smoking and having lots of fun on the course and good networking party after. And some
more hole-in-one contests, different things this year.
Awesome.
Sweet.
All right, guys. So I want to say thanks everybody for coming. Have a great night. Bye for now.
Thanks, everyone.
Yeah.
Everybody.